Hello everyone. In this video, we'll talk about the different factors that one needs to consider before buying a share of a particular business. Now, many a times what you have seen is that people, just go to the particular trading app or particular app and just buy a share of that particular business without knowing what exactly does that company do, or what are the various services that are being offered by that particular company, and just by some rumors, or maybe by some gut feeling that the share price has been trading historically trading in this particular range, and if it has come out of that range, or if it is trading below that range, then one just needs to buy it and get profit from it. So that is actually not the right way in which a particular investor, that may suffice for a trader, because that is the way things work in trading. Maybe the technical analysis or some other price action, they can gauge it and then profit from it. But if you're if you're an investor, and if you're looking from a long-term perspective, then there are few things that we need to consider before buying a share of a price. And believe me, that price is the last thing that you really want to consider if you are in from an, again, from an investment perspective I'm talking about. So broadly, there are four categories that one needs to consider before buying a share of that particular business, and these can be categorized as business fundamentals, management, financials, and valuation. And we'll talk about each of these factors in detail in this particular video. And to begin with, so first we need to understand that what exactly does the company do. So when I'm talking about the business part, so the first point is that is it simple and understandable? So what it means is that do we really understand the business, that what exactly is it, if it is a manufacturing company, then do we really understand that what are the various products or various assembly lines that the company has? Do we really understand that what are its products that is being offered to the customer? Or if it is in a service, if it operates in a service environment, then do we really understand that what are the various services that the particular company is giving it to its clients, and things like that, so it is very important that one should understand, if one, or if he or she is buying a stock of that company, one should really understand that if that particular business, how it works, what are the different forces that guides that particular business. If it is, let's say, if it is in a if it is the oil refining business, then maybe the price of the crude oil will play a major factor. So that is the reason, we talk every time we talk about, whenever we are talking about value investing, it is all about defining your circle of competence. So basically, again, as I mentioned in many of my previous videos, that if I'm operating in a particular sector, then I have a knowledge of that sector. So there's a high probability that I may understand a lot of things about that particular sector. So that is the reason one should restrict himself or herself in that in which he or she is comfortable with, or in which he or she has a knowledge of that particular sector. And that is the reason it is important that one should really understand the business, what are the various types of products or the services that that particular business offers. Because the reason is why we are emphasizing, or why we are stressing so much on that, is because if there is a, if there is a change in the environment, or in the operating environment of that particular business, then we may not even get a hint of it, that what on earth has changed. And then the only thing that we will see is the reduction, or the drop in the share price of that particular business. So it is imperative that one should understand that particular business, what it actually does. So that was about first point, that is it simple and understandable. Then the second point about under business factor is that does the business have consistent operating history. Here the point is that it should not be like that, it is if it is startup, then I think it is very difficult to value. So that is the reason many value investors, they prefer to invest in companies which have consistent operating history, which have been there for a long period of time. So let's say, for example, companies like Asian Paints, Colgate, Hindustan Unilever, these have been there for the last, I don't know, say 40, 50, 60 years, and these have good track record of creating alpha, or creating wealth for investors as well. So that is what we should aim for. Now there are people who invest in startups and all. So I'm not saying that one should not invest in startups and all, but then from an investing perspective, I'm saying that we should look for the business that have an consistent operating history. So at least it should have it should have been there for the last 15, 20 years, so that so basically what happens is, if a company has a large operating consistent operating history, so we'll come to know that how it has operated how it has operated in a particular cycles, because let's say if we are saying that how it has operated in the last 10 years, so usually the 10 years will have few years of up cycle wherein the business conditions are very good, and then a few years wherein the business conditions are not so good. So how did the company navigate through all those the headwinds and the tailwinds that we say in business parlance. So we need to see that how the the company has navigated through that path. So that is the reason it is important that one should focus on the companies that have a consistent operating history. So that was point number two. And the third one is very important, what Warren Buffett usually calls it as a moat, which is nothing but a durable competitive advantage. So first thing is that first we need to find out what is the competitive advantage of that particular company over its competitors. Does it have a particular USP, or does it, what separates that business from its competitors? And second is that moat, or is that strategic advantage sustainable over a period of time? And when we are saying period of time, it is longer period of time, let's say 20 years, 30 years, 40 years down the line. So just to give you an example, that if I'm talking about, let's say, a company like DMart, so the moat of a DMart is that it is the lowest cost operator, right? So it offers prices at a very, you know lesser rates as compared to its competitors, and that is the reason DMart is such a great business. Or for example, let's say Asian Paints. So Asian Paints, one of the moats is that it has a huge distribution network, right? It has got its retail outlets, it has got its distributors, and all these people working throughout India, and even abroad as well. So let's say if tomorrow, if we have we have some ideas in our mind and all, and we want to start a paint company, then we definitely cannot compete with giants like Asian Paint, because of the fact that they have a huge distribution networks spread all across India, and even abroad as well. So for Asian Paints, the mode becomes a strong distribution network, right? And same goes for Maruti as well, that it has got huge brand value, and it has got huge distribution network with its retail networks and all things like that. So that is what the third point says, that first we need to identify whether there is a strategic competitive advantage that a company has over its competitors, and is it really sustainable over a long period of time. So that was broadly on account of the business part. So let's go to second point, which is basically management, and again, very very important from whenever we are trying to value a business from a qualitative perspective. And as I've mentioned multiple times, that Philip Fisher, the legendary investor, always used to emphasize on the management part, and he has made his living based on judging people. And so coming to management part, the first point is the management candid and fair with shareholders. So basically the point here is that usually the management had a tendency that whenever they get any good results, they are going to beat the trumpet out of it in front of media and all everything. But whenever there are any setbacks, and usually the setbacks happen in all good businesses, in all businesses, whether good, whether bad, that is the part and parcel of life. So is the management fair and candid, and is the management have the sense of responsibility to go to the media, or wherever they want to address the shareholders, and accept that yes, they have done a mistake, and that this is the mistake that they have done, and these are the particular learnings from that mistake, and let's assure our shareholders that we are not going to repeat them in future. And also, is it and because it takes immense strength to accept in front of everyone that these are the few of the mistakes that we have done, and these are the learnings from it. So usually investors like Warren Buffett and also, they prefer to invest in companies where the management is fair and candid with the shareholders, and they don't have any they don't have any shady background as well. So that is also one of the key tenets of a management perspective, that owners should be candid, fair, and they should not be doing any some shoddy activities where the trust is not there. So that was about first point. Second point is the management rational while allocating the capital? Again, very important point. And because we know that managers are the managers are responsible for allocating capital, and we know that shareholder value is created over a long period of time, and the price of a stock is determined by the value over a long period of time. And again, this value depends on how the management is allocating the capital that is there in the business. So again, very important that if and one of the important points that Warren Buffett particularly stresses, that does the management resist the institutional imperative. So basically what he says is that within the management also there is a herd mentality, that if many of the competitors of a particular company are venturing into different businesses, which they call it as a diversification and all. So does the management avoid that institutional imperative, that if because it all depends on how you are allocating your capital, and it is very important that one should allocate the capital sensibly. So again, very important point, and I think I have also mentioned in one of my previous videos that if one really wants to understand how capital allocation has been done in a great manner by a few of the greatest CEOs on this in the history of financial markets, then one should definitely try reading a book called The Outsiders. So maybe you can visit my that video and then read that particular book. So that was about the second point, that is management is the management really rational about allocating the capital. And the third point is that does the management think and operate like the owners, because and very important that if a management is just if a management is just bothered about their paychecks and all, then definitely management's interest and shareholders interests are not aligned to each other. So it is very important that management should think and operate like owners, and this is one of the key and tenets of Berkshire Hathaway, that they only invest in those companies where they have trust in the people with whom they work, and they give full authority to their managers, and they have been told to work like as if they are the owners of that particular as if they are the owners of that particular business. So that is very important, that if I am an owner of a business, then definitely my I have a huge stake in my business, and then obviously my interests are in alignment with those of my shareholders, and definitely I'm going to take rational decisions, which in turn will help to increase the value of a particular stock. So that was on account of management. Key, uh, uh, third category is financials, and one of the important things that we need to look in case of financials is that we need to see how the different assets of a company are funded, right, or how they're financed. And basically in this we are talking about the typical debt to equity ratio, that how they are financed, and we are looking at capital structure of a company. And again, it depends on the business model that a company is having. So if a company has robust free cash flows, if a company has like companies which operate in FMCG sector, or maybe the companies which are in utilities and all, where the free cash flows don't get affected much by the economic environments. So maybe those companies have a they have the luxury to take on particular debt, and maybe they can even repay their debt on time as and when it is called for. But then the companies which are more of a cyclical in nature, like steel, autos and all, because they don't have a robust free cash flows throughout their operating history, so these companies should ideally avoid and should not leverage so much to fund their assets. That is why it becomes important that how the assets are funded, and more important than that is important that one should understand exactly what is the business model and in which a particular sector the company operates in. The second point is, does the company have consistent free cash flows, which is also called owner's earnings. And I think we have discussed in our in our few of our earlier videos in intrinsic valuation calculation, that it is very important to have consistent free cash flows, because that is the excess cash that is available for the owners, which they can deploy more sensibly and generate more returns out of it. So basically it is like similar to the point wherein we were talking about, is the management rational about allocating the capital. So for that one should have the free cash flows in the first place, and this is why it is very important to see whether the company has a consistent free cash flows. Now in case of let's say cyclical sectors like steel or autos or cement and all. Basically, these, since as the name suggests, they are cyclical in nature. They do not have consistent free cash flows, or they may have huge free cash flows in some particular year, and then they may have a negative free cash flows for some period of time. So usually we should avoid such kind of sectors unless and until we have a very deep knowledge of that particular sector. and that is the reason it says that a company should have consistent free cash flows so that the managers can take the decisions rationally and invest that excess capital to generate more returns on that particular capital. So that was about second point. And the third point is, does the business generate a return on invested capital, or ROC, the return on capital employed, which is greater than the weighted average cost of capital, or simply cost of capital? And why it is important is because basically if I'm not generating returns on my capital greater than cost of capital, then what is happening is over a period of time the value of that particular company will erode, and it will not generate returns to the shareholders over a long period of time. So that is the reason it is important that the return on capital employed or return on invested capital should be greater than the cost of capital. And I think we have discussed at length about this particular point when we were doing our video on intrinsic valuation calculation. So I think you can check out that video as well to understand what exactly it means in detail. And the last point is, and this is what the last point talks about valuation, and this is where the price will actually come into picture. And so basically the concept is that we should not look at the price before we are not unless and until we have not done our homework on these three particular points, which is business, management, and financials. So if we have if we have done our due diligence on these particular factors, and if the particular stock has passed these three filters, then the fourth point, which is valuation, wherein the price of that particular stock comes into picture. And even before that, we need to understand that is it possible to calculate the intrinsic value of that company. And many a times what happens, as I said, that in even in cyclical sectors, it is very difficult to gauge the free cash flows of a business over a particular, let's say 5 years, 10 years down the line, because it is all depends on what part of cycle we are in, right? And being a cyclical in nature, the free cash flows will fluctuate greatly. So that is the reason one should restrict himself to particular industry wherein I have a great knowledge about that. And that is why it is imperative that we define a circle of competence. And let's say once I have defined that, and if I'm able to calculate the free cash flows 5 years, 10 years down the line, and then if I'm able to calculate the intrinsic value of that stock, that those are the businesses where I should focus my interest, right? So that is about first point, that is it possible to calculate its intrinsic value with fair assumptions, right? So that was about the first point. And the second point is that is it available at a fair discount from its intrinsic value? And again, the concept of margin of safety, which we have discussed at length in many of our previous videos, that if we have derived at an intrinsic value of, let's say, 100 rupees, and if the particular business is available at, let's say, 60 rupees or 66 rupees, or two-thirds of what what Benjamin Graham had defined in his book. So if that particular business is available at 50% or 60% of the intrinsic value, then only one should buy, and buy a good chunk of net worth in that particular business. So this is how usually the story goes, that we start with the business part, that do we really understand the business and all, then we move to management. Is the management fair and candid with shareholder? And it's also important that management should not be involved in some scams and all. So we need to do a background check of particular management, who the key management people are in that particular, who are running the business. Then the third is that the financials should be great. There should not be any, there shouldn't be anything which does not add value to the shareholder. So important points are if whether the return on capital employed is greater than the cost of capital, and we also need to see the debt structure and the equity structure of that particular company. And the last point, and the last is where the current market price will come into picture after we define the intrinsic value of that stock and compare the market value of that particular stock. So guys, that was for today. And if you have any doubt regarding this video, please let me know in the comment section. I'll be very happy to help you out. So thank you and have a nice day.